And then finally, moving on to the last transaction, it says you are in a 25% tax bracket, but won't pay taxes for another 6 months. So this one's actually pretty tricky. And for this one, we actually have to use information from the earlier transactions. And so I put a summary here of all of the transactions that we've inputted so far. And more specifically, to get this transaction, the amount for it, the dollar value for it, we're going to have to use this portion here, the portion of the income statement. So what we can actually start doing is we could start making the income statement. So the income statement, it's for a period of time. So we would have the income statement. Now usually the name of the company would go up here. There was no name given, so I'll just leave it blank. And then this is for a period of time, so it'll be for month ended. And so what we could start doing is inputting the values for the income statement. So notice we made $6,000 of service revenue. So we'll have service revenue. This here will be 6,000. And then we could input the different kinds of expenses. So notice we had an advertising expense here, but notice we also had an advertising expense right there. And so we can group those in one. So we'll have advertising expense. And that's going to be what? 36 plus the 480. So let's actually cross out what we end up using. So 36 plus the 480, that would give us 516. So our total advertising expense was 516. Then we had a wage expense for the cleaning lady. That was 2,000. Right? And the fact that it's brackets, meaning that it's a negative value, so we're going to be subtracting it. So that would be this. Then we had 300 of the car expense. You could put these as one line to maybe make it more compact. Just don't have as much room here to work with. So we'll have a car expense for 300. Then we'll have a supply expense, the supplies that we used. That was 480. And then we had the interest expense of $20. So we'll have an interest expense for $20. And so what happens when you net this out? You'd end up getting 2,684. And what this is income before tax. So the net income on an income statement, we know it's revenue minus expenses. That gives us net income. Now, net income on an income statement, that's an after-tax amount. And so part of expenses is going to be the tax that you have to pay. Right? So what would happen is we're in a 25% tax bracket. That tax would be calculated on this amount. The tax is the last expense before the net income. So we would net out all of this. We get 2,684. And then the tax that we have to pay, or the tax that was incurred, is 25% of 2,684. So 0.25 times 2,684 would give us 671. So that's the actual tax there. And then we finally get income after tax or net income. Or sometimes, depending on your prof or textbook, you'll see this profit before tax or earnings before tax, and then earnings or profit. I'm just going to say net income here. Then subtracting these, we would end up getting, what, 2013? So that's what the net income would be for this period, right? So that's the full detailed income statement right there. Now, what about this tax transaction? How would we input it in the system here? Well, notice it said that the taxes won't be paid for another 6 months, and you're going to pay taxes with cash. However, it has been incurred within the month. So as you do business, the taxes are incurred as you're doing business, so that expense is incurred. However, you're not going to pay it yet for 6 months, but it's still incurred, so there is a tax expense of $671 that's incurred. This is transaction 13. However, you're not paying it yet. So what does that mean? Where would the other, remember there's got to be at least another input, double entry accounting. Where would the other input go? Well, you owe that tax in the future. So it would be a liability. So you would put plus 671 over here. And this would be called an income tax payable. And then you just keep adding to this every month. And then when you finally pay the taxes, what would happen is you would minus cash and then you would minus this amount right there, whatever that amount ends up being on the balance sheet once you're paying the taxes. So just because you're not paying the taxes yet doesn't mean you're not incurring them. You are incurring them every month. So that's an expense. And then you owe that money in the future, so that's a payable, and more specifically, it's called an income tax payable, right? And we already incorporated that here. So the income tax is a little tricky. You gotta create this, you gotta get this amount, the income before tax, and then calculate the tax on that amount. And that gives you your net income, right? So you gotta go back to the transactions and use that information right there. All right, so we have the income statement. So now we can actually make the balance sheet, right? So the balance sheet, we would actually use just these three columns over here. The revenue, the expenses were used. There were no dividends, and so I left that out in this example. Now, if there were dividends, where would that go? That would affect the retained earnings. So what happens is we make the income statement, and then we make the statement of retained earnings. We're not asked to in this specific example, but if we were to make it, what would we start with? Well, we would start with the beginning retained earnings. Because this is a new business, there was no balance sheet at the beginning. So assets, liabilities, equities, they were all zero. Retained earnings is part of equity, so that was zero as well. We add net income, which is $2,013. And then if there were dividends, you'd subtract them here. But in this case, there were no dividends. So that was zero. And then what do we end up with? We end up with our ending retained earnings of $2,013, like that. And then this amount here is going on the balance sheet that we're about to create. So now let's take this information here and create the balance sheet, a detailed balance sheet. So we're going to create the balance sheet here. Now we have a balance sheet, and remember, a balance sheet is at a specific point in time. So what would happen? The company name would go up here, and then over here you would have the specific date of the end of the period. Remember, an income statement is for a period, for the month ended. So for the balance sheet, you'd have a specific date here. It's a snapshot on a specific day. And then we're not given the actual month or dates in this example, but let's say it was like for September, this would be September 30th over here. So I'm just going to leave it as balance sheet for now. And let's start with the assets. So we're going to have the assets on the left side, and then we have these specific accounts over here. So let's start with the one that's affected the most, which is the cash. So just to split this off here, right, the balance sheet is going to be here. So cash, let's go through these one by one. 6,000 cash. Then notice we got another 5,100 cash. So that would be what? 11,100 minus 2,000 cash. So that would be 9,100 minus 300. That would be 8,800. And then we got minus 20 cash. So 8,800 minus 20 would give us 8,780. So our cash here would be 8,780 after we net all of the transactions that affected the cash. Now, after cash, usually the order on the assets is most liquid to least liquid. And so after cash is usually like very short-term investments. There's nothing like that for this company. So the next one would be accounts receivable. So we have accounts receivable. Remember, we're owed $900 for the services that we already provided. So that would be next. After that, let's put the prepaid advertising. Which is what? We had 96 and then we had minus 36. So we end up with $60 left of prepaid advertising, which is an asset. And then what's left is the supplies. We start off with 600 supplies, but then 480 were used. So we're left with supplies of 120, like that. And so now what would happen is we could total up these values. So what's our total assets going to be? Well, if we total all of these up here, we would end up getting 9,860. And we would also get this value if we totaled up all of this column over here, this asset column. We would get that value. It's just now we're making the balance sheet, so we're going into a little bit more detail. So now that we have the assets figured out, let's deal with the liabilities, which is going to be up here. And there are three types of liabilities here. So the first one, the current liabilities, the accounts payable. So we can add all of those up. We would get accounts payable. If you add all those values up, it would be 1,176. Then we have the income tax payable. That's also a current liability because that's going to be paid within a year, right? So liabilities, what happens is at the top we have current liabilities. Same with assets. Current assets, the more liquid assets. And then after come the long-term assets and then the long-term liabilities. So accounts payable, 1,176. Then would be the income tax payable. And then that would be 671. Like that. And then we have the loan, which we said is a non-current asset. It's a long-term liability. So then we have, let's call it the bank loan. And then that would be, or actually, sorry, not bank loan. We called it a loan payable, my bad. So that would be 3,000 right there. So that is the liability section of the balance sheet. And then we have the equity section. And the equity section, pretty easy. There's the capital or owner's capital, which is just the 3,000. There wasn't any extra investments made within the company. It was just that 3,000 initially. So that would be 3,000. And then we have that retained earnings, which we calculated from the statement of retained earnings, which we had to use this value from the income statement for. And that ending retained earnings, we calculated it to be 2013. And so if you net all of these numbers out, what would happen is usually the last line here on the right side is called total liabilities and equity. It's basically adding all of those values up on that right side. And then when you do that, you would end up getting this value, 9,860. And that's how you could check that everything is balancing out. You can also check your transactions, making sure that everything balances out from the chart that we had, the full filled in chart. So you'd add up all of this, add up all this, this, right? And then you'd have the two sides, make sure the total on the left side equals the total on the right side. But then the second step is making sure this balances out because it incorporates the income statement, which goes into the statement of retained earnings, and then from that, it goes into the retained earnings plus all of the other balance sheet items. All right, so big example, but this here is the balance sheet, the detailed balance sheet at the end of the month, and then this here is the detailed income statement for the month.